In this video, I'm going to explain a broken wing butterfly spread options trading strategy step by step from the perspective of a professional options trader. So, if you're trying to understand how a broken wing butterfly spread works, why it's important, and how it can help you become a better trader, then this is the video for you. If you don't have time to watch the whole video and would rather just get our cheat sheet explaining the most important things with broken wing butterfly spreads, you can click the button that should pop up on the corner of this video or go to the link I have in the description. My name's Scott Bauer and I've been trading for over 30 years. I'm a former Goldman Sachs VP, and today I'm going to teach you how the real professionals on Wall Street use broken wing butterfly spreads to potentially find big profits in the markets. Don't forget to hit that like button nearby and subscribe to our channel if you want to learn more about options trading and our favorite options trading strategies. Let's dive in. All right, everybody, we are now going to talk about the ins and outs and why we would do something called a broken wing butterfly. We've already talked about kind of the nuances, the strategy behind what a butterfly spread is and why we would do it, what the reward, what the risk is, and now we're going to dive into a broken wing butterfly. Okay, so again, you can create this type of position whether you're bullish, bearish, or neutral. So what we're going to do on this one, since we already talked about a bullish butterfly potential in Tesla, let's look at a bearish potential broken wing butterfly. Now, let's review real quickly. What were the setups, the nuances of a regular butterfly? Okay, so a regular butterfly was a 1 to 2 to 1 ratio, but the key was that the distance between the strikes are symmetrical. Okay, so the long might be $5 wide, the short $5 wide, 10 and 10, etc., etc. The difference between a regular butterfly and a broken wing, and actually before I go into that, let's talk about why the wing. Okay, in option terminology, the wings of a spread, okay, are known as the outer options, the outer strikes. Those are the wings. The middle, okay, is known as the guts. That's, trader terminology back from the floor. So the wings on the outside, the guts in the middle. Okay, so the wings on a regular butterfly are equidistant from the guts, from the middle. But in a broken wing, the difference is the wings are not symmetrical. Okay, so it's still a 1 to 2 to 1 ratio because we still always want to lock in and know that we have our maximum risk defined. So we still need to have an equal number of long options and short options. But in a broken wing, what we look to do is skew the position directionally a little bit more. Okay, again, could be bullish, could be bearish, but by skewing the strikes and having a longer spread, or the long spread, that is wider than the short spread, it gives us more delta or more direction. So let's take a look here. Okay, and let's take a look at QCOM. Okay, we're just going to take a look at QCOM. And now remember, we're going to assume, that we are bearish. Okay, so if we look at, again, April 14th expiration, QCOM is trading right at 152.5 right now. So if we look to see the expected move, okay, which is the first thing we always want to do because we always want to get a target as to our short strike. Okay, so if we look at the straddle, adding together the call and the put option of the at the money strike at the expiration that we're looking at, we see that it's about $8. Okay, that's adding together the call and the put. It's about $8. Okay, so QCOM is trading 152.5, and expected move to the April 14th expiration is $8. Again, expected move does not tell us which direction a stock is going to move. It only tells us the size of the expected move with a 68% probability. So assuming that we are bearish, we are targeting 144.5 at expiration. Okay, now I can tell you there's not going to be a 144.5 strike. So what we want to do in that instance is always target the strike closest to where we think the stock is going. In this case, we could either choose 144 or 145. We're going to keep a 145 just for symmetrical, for mathematical purposes here. Okay, so if we were putting on a bearish butterfly, a regular put butterfly, we might put on the 150, 145, 140. Okay, where our long put spread is $5 wide, short put spread is also $5 wide. Okay, so a normal butterfly might be the 150, 145, 140. And we could do that, you could see, for right around 70 cents. Again, we're trying to hit the nail on the head. We're trying to pin the tail on the donkey, right? 145 being the optimal place. But let's say we're right in that the stock goes down because we were bearish. But what if the stock flies down through the lowest strike here? Then that spread could be worth zero. So the benefit and the difference of using a broken wing butterfly, it gives us additional direction, and since the strikes are not symmetrical, if the stock trades past the last strike, there will still be value to this position. Okay, try and think about that for a moment. In the Tesla example, when we went through a normal butterfly, and I'll just bring that up for reference here in a second. Okay, we had the 1200, 1220, 1240. What happened if we got to that last strike of 1240 or even higher? The value of the spread was zero. That's because the long spread and the short spread were equidistant. Okay? But in the case of the broken wing butterfly, we might do something like this. Rather than the 150, 145, 140, we might do the 150, 145, so that's $5 wide, but then on the short side, maybe only do the 143. So what's going to happen if we tighten that up on the short side there? Well, it's going to make this more expensive, first of all. So you can see the price of the spread went up by about 40%. It went up from 70 cents to about $1, $1.05 or so. But let's really see what happens. Okay, so the broken wing is the 150, 145, 143. Still in a 1 to 2 to 1 ratio. Okay, when you break that down, what do we have? Okay, breaking it down, we have a long 150, 145 put spread, $5 wide, but then on the short side, we only have a short 145, 143 put spread. $5 wide on our long, $2 wide on our short. So it's not symmetrical on either side. So what does that do for us? Why would we ever want to put on a position like that? Well, we still want the stock to move to our short strike. As we've mentioned before, in every example, every position we have, we still, in a perfect world, have our maximum potential reward at the short strike. That still holds the case here. But now, if we start moving beyond that short strike, we still make money, even if the stock goes beyond that last strike. Okay, so let's go through some examples here. So let's say we bought the 150, 145, 143, and we paid $1. Anything above 150 at expiration, what's this thing going to be worth? It's going to be worth 0, right? Because all the options are going to be worthless. Okay, let's say we're at 147. Okay, our long spread's going to be worth $3. Short spread's going to be worth 0. So the value of this butterfly will be worth $3. What you'll see here is the max is still going to be at the short strike. So at 145 at expiration, it's worth $5. Now what happens if we start to move down below that short strike? Yeah, we're going to start giving back some of that value. So 144 at expiration, the long spread is still worth 5. The short spread is worth what? Let's break it down like we did in the butterfly example. The long 150 put is going to be worth 6. The short 145 put is going to be worth 1, but we had 2 of those, right? So the value is going to be worth $4. At 143 at expiration, the long option, the 150, is going to be worth 7. The short 145s are worth $2 each for a value of 3. Now, that's going to be our magic number. That's going to be our magic number, which I'll work through here in a moment. But if we go back to the strikes up here, okay, knowing that we have a long $5 spread and a short $2 spread, we can tell from that if the stock went below the lowest strike, this will never be worth less than $3. Where in the regular butterfly, once we hit that end strike and it went beyond that, the spread was worth 0. So let's play this out here. Let's say the stock goes to 140. Our long strike is worth 10. The short strikes are worth 5 each. Okay. But then our long 143 strike is worth 3 for a value of $3. Let's look at 100. Okay. If the stock is 100 at expiration, the long is going to be worth 50. The shorts are going to be worth $45 each. And then our long 143 is going to be worth 43 for a value of $3. So what a broken wing butterfly does, costs a little bit more. We still look for the stock to move to the short strike. But what it does is on a move further beyond the end strike, we still make money. Whereas in a regular butterfly, we don't. That's why a broken wing put or call butterfly, either way, costs more than a regular butterfly. It's still the same basic concept. We still do it in a 1 to 2 to 1 ratio. We still have one long spread versus one short spread, but just the difference between the spreads are not symmetrical. So it gives us more direction. That is really the big difference between a regular butterfly and a broken wing butterfly. So thank you very much, everybody. Butterfly concepts, butterfly strategies are very, very useful. Many traders use them, but it is extremely helpful to understand the difference between a regular butterfly and a broken wing butterfly, knowing what the maximum values could be, maximum risk, so on and so forth. Thank you so much for watching, everybody. Please remember to like, comment, and subscribe.